The business model for Mosman is to build a production base and then reinvest that money into higher risk exploration. And we are delivering on that strategy that I'll explain as we go through the presentation. So the capital raise has funded additional wells this year. Unfortunately, it depresses the share price, so we've got a ridiculously low share price and a ridiculously low market cap, and thereby the opportunity for you as investors. So at the moment, I'll go through more detail on the exploration in Australia and the production in the USA. So last few years we exited New Zealand and are busy building the production base in the USA. Part of that is the operational environment. As you know, I think here in the UK, you've seen it increasingly difficult for people to operate. In New Zealand, it got very difficult to operate with increasing bureaucracy. In the US, happily, particularly in Texas, it's business as usual. That's what they do, and it's all straightforward. It's like delivering bread to the corner store. The oil and gas business just keeps on rolling. So this is showing one of the operations in Texas. We've got a number of projects that I'll show in detail, but we have established a production base, we've established operatorship, relationships and connections, and we're building the portfolio. Coming up in the near term, we have a well that's being recompleted that we're looking forward to boost production. We've got 2 other wells funded for drilling this year and looking at other development options on the back of that. So quite active program, and with the recent capital raise, well funded for that activity. So onshore USA, we now have 4 producing assets. The Stanley project that I'll talk about, the Welch and Arkoma, and this is the photograph of the next well site that we're planning to use. What it shows here is the terrain is easy. We're actually going to piggyback on a previous well site which had mechanical problems, and we're actually going to directionally drill from this site down. We've developed that, it's not new technology, but we've demonstrated it commercially effective to directionally drill. We've got stacked targets. We can target the well to exactly the right place to produce each target zone, and it also means instead of cutting new roads and new drill pads, we're able to use this existing drill pad that also has a gas pipeline nearby. This well used to produce gas as well as oil. High impact exploration in the Amadeus Basin in Central Australia. Santos are drilling a well there as we speak. The results on that are expected shortly in the next 2 weeks. Our acreage next door to that will benefit very much from the understanding the results of that well. It's always nice to have someone else to take the initial exploration risk, and we're well positioned on the back of a good result in that Santos well. So looking at where we are in the US, our main man in the US is based in Dallas. Our first step into the US was at Strawn, which is an easy drive from Dallas, and that established Mosman as an operator. We then, on the back of that, found a great opportunity at Welch in the Permian. So Welch has existing vertical production wells, but the major operators either side of us, Devon and Occidental, have drilled horizontal wells, which both significantly increases production and also reserves. So we've done the feasibility study that demonstrates that's commercially viable, and that's sitting in our portfolio. We've added value on that project. We got it at knockdown price in a low oil price environment. We're successfully operating it with the existing vertical wells, and it's sitting there with the development potential for horizontal wells. We then picked up an interest in a project, Arkoma, up in Oklahoma. This again has got stacked pay from the Wilcox and several other zones above that. Those wells are producing nicely, and there's plenty of opportunity to expand on that base. We bought in when there were a couple of wells that had already been drilled, funded recompletions which were successful, and then we're looking at further development wells on that project. We're also looking at one of the nice things about the project in Oklahoma is an existing 3D seismic, and that technology is really effective at finding the untapped zones in these old areas. So Devon had paid for the 3D seismic, chasing a shale play that didn't work out for them. The operator that we bought into has access to that 3D data, so that's really our focus, where the data exists, and that really allows you to target your next wells. Coming down then into southeast Texas, we've teamed up with a couple of guys, an American and Australian, who are well established in the oil business, and they're Barry and Jack. Their company's called Baja, and they really know the business, and we're very happy with that partnership. So in there we have producing wells at Stanley, and we have two other projects that will be drilled in the near future at Challenger and Champion. So I claim we're building a production base. I think you can see here steady and continued progress, with Strawn as the stepping stone project, Welch with the vertical wells, Arkoma is a steady contributor, and then the first well drill with Baja, which was a well down below an oil field where the shallow zones are producing. The deep zones are identified on 3D seismic, and Stanley 1 has been successfully drilled, completed, and now production track record. The initial result on Stanley was gas combined with oil. We've recompleted it into an oil zone. Still considerable gas reserve in the Wilcox, but the gas infrastructure is not in place, so the economics of producing that gas were not good. So we recompleted in the oil zone, but significant gas in the Wilcox there once we get the gas infrastructure organised. So similar story on a net basis. We obviously have different working interests in different projects, but you can see the same profile, established track record. So focusing then at the Stanley project, existing infrastructure for the shallow wells, which was great because as we drill these deep wells, we're able to produce oil to some of the unused tanks, so move quickly from drilling to production. There's some gas infrastructure there, but it's limited, so we are looking forward to upgrading that infrastructure in due course. These wells flow naturally, so we get actually a slight premium to WTI because of the quality of the oil, very low operating costs because they flow naturally, so very high margin wells, and we can quickly drill and get these wells on stream. So a combination of developed and undeveloped projects, and working interest varies a little bit across each of these projects. All this presentation will be on our website for anyone who wants to go through the detail. So I'll kind of skip the detail, but focus on the main story. So Champion and Challenger. So two projects, both big upside from a very given Mosman's modest base, these are significant upside projects that will be drilled and developed with some wells funded and to be drilled in the near future. The Challenger is a field that has had some wells producing, still a couple of them that are producing, had some mechanical problems. 3D seismic allows us to target the unproduced areas, and there's enough information from that area to have resources. So we can put out the numbers on the significant resources sitting there at Challenger. The other good part of that is because there's a couple of wells that do produce, that lease is held by production, and we can sit and drill those wells when it suits us. Coming back to Welch, we talked about the horizontal wells. These are the Mosman leases, so we have 4 lease areas. There's water injection, maintaining the reservoir pressure in the Strawn field. What we've shown here in red is the projected horizontal wells that were part of the feasibility study, they're about $1.5–2 million each, but they have a commercial payout on each of those wells at current oil prices. So that's an attractive development project. Whether we develop that or whether we having added value, getting the field back on stream, it may be one that we bring someone else in to fund that development. So from our steady progress over the last couple of years, we start to look forward. So you can see in March 2019, a good step up with Arkoma. But as we look forward, the Stanley 2 is a well which was drilled. Again, the first zone, it wasn't clear from the logs whether it was oil or gas. We produced it as primarily gas. I mean, that's good news in the medium term, but the short term, because of the lack of gas infrastructure, we're going to recomplete that well. All of the approvals are in, and that recompletion should happen in the next week or two. You can see just even that recompletion of that one well is a significant step up at Stanley. The joint venture has now recently also agreed to progress Stanley 3 and Stanley 4. So the data that we get from these wells is really useful. It's not only the production that we get from these wells, but together with the 3D seismic, we're identifying sands that have not been produced from the other wells in the area, and there's 6 or 7 potential production zones in each of these wells, and it's very easy, cheap and easy to move from one zone to the next, and so we're cherry picking through those zones. It's also identifying other development well potential. So Stanley 3 is going to go ahead and probably followed by Stanley 4. Falcon is a well that's to be drilled on the well pad that I showed you, probably in August or September this year. That's a significant addition, and it's also the first well in that project area. So again, success at that well will give us a whole new area to develop. The potential impact of the Welch horizontal wells, we've shown here just one well. The plan would be to drill 4 or 5 of those, so you can see the impact that the development of Welch would have on the production profile. Coming then to the significant upside of the exploration potential in Australia. So you can see Alice Springs to orientate yourselves into the centre of Australia. Because of the less easy access, this area has not been drilled or developed, but there has been production from the Mereenie oil and gas field and the Palm Valley gas field, supplying Darwin with gas for over 20 years, and more recently with the gas market in Australia short of gas, there's been a lot more activity in this area. But the really interesting well that's been drilled is the Dukas prospect, shown here as the star in the centre. This is a well which is drilled by Santos, a fairly big Australian oil company. It survived their budget cuts over the last 3 or 4 years. They've continued to persevere with gaining additional seismic. And what's really interesting about this well is it's going to test the Dukas prospect, which is a subsalt play. And the significance of subsalt is that salt is a fantastic seal. Seals not only hydrocarbons but also helium. So the adjacent wells, including McGee, shown here off to the right, had a significant helium content. Helium is worth 10 or 12 times the value of natural gas. It's in shortage. Investors are getting increasingly interested in the where's the next helium going to come from, used in scientific equipment like MRI machines. It's on the USA important commodity list. So Dukas has several TCF potential in natural gas. That alone makes it a significant project for Santos, but the helium content is 5 or 6% and is significant for Santos. And we have been able to track, looking at the existing seismic in EP145, we've been able to tie in that we have the same subsalt potential in EP145 in the deeper section, as well as the Marini type potential in the shallow zone. So we wait with bated breath for the results of the Dukas well in the next few weeks. So coming back to the summary, we're delivering on the business plan. We were able to move into the US and acquire assets in a low oil price environment. We've now developed the relationships with Baja as the operator. We're increasing production and cash flow, and the recent capital raise has allowed us to accelerate drilling. That's why we raised capital. We've got so many good prospects here, we need to get on and drill them. And those identified prospects will have a significant impact on Mosman's production profile and hence cash flow and revenue. Thank you.
So obviously that fanfare was deliberate during your summary. If you can do that for all the summaries, for all the presenters, that would be very good. Okay, so I'm just having a look at the medium-term objectives of Mosman Oil and Gas and what you've told us there. So Strawn established you as an operator. So which project will get you to the medium-term objective of being profitable at corporate level?
So really the wells that we're drilling in the next few weeks. So the Stanley 2 recompletion. We're very happy with Stanley 1 that came in with forecast 150 barrels a day. It's producing at that level. We expect the same sort of result with the Stanley 2 recompletion, and that's going to get us that next step up. And then the Falcon well is an important well for us. So really we're just rolling out the implementation of the strategy, and yeah, these are nice milestones to tick off along the way. So I think really this year is, I think we've already established that production base. We're very keen to see that step up 1 or 2 levels this year.
Questions?
Hello.
Hi.
On an earlier slide, you said that the workovers for the three assets, Strawn, Arkoma and Welsh, are complete. In this morning's update, you highlighted that Welsh requires additional workovers to maintain production, but there's no mention of Arkoma. Now, one of the big surprises from a recent update was the step up, which you mentioned in Arkoma. Why does Welsh require the workover, Arkoma doesn't, and is Arkoma sustainable?
Yeah, good questions, thank you. So the experience at Strawn was very useful for very low cost, low entry. We got a much better understanding of the really the maintenance issues around old oil fields. So because the equipment has been there for some time and in low oil price environments the maintenance drops off, you get periodic problems, kind of like running an old car where something breaks and needs to be fixed. So at Welch, the wells are pumped with nodding donkeys, and periodically the rod string breaks and you lose production until you go in and repair the rod string. So that's the sort of workover that we see at Strawn and at Welch. It doesn't cost a lot of money, but you lose production while the equipment gets repaired. And at Welch we had the water injection pump went down for a while, production drops off a little while. So those are fixed up. It was a very wet winter in the US, so access issues at Welch and at some of the access tracks are just dirt tracks through cotton fields, and when it gets too wet you don't want to cut up the tracks. So getting in there, but now is good weather, so we're able to get in there, and there's always an economic decision about how much to spend on workovers. We've got a couple of wells which require more expensive workovers, and we make the economic decision whether we spend that much additional money for those additional barrels. So that's the sort of workover that we get at Welch. It's, as I say, a bit like fixing your old car. At Strawn, it's quite different. At Strawn, we have multiple pay zones, and the primary target was the deep Wilcox, and there were 3 sands there. Pre-drill, we thought we'd have water in the lowest Welch, or risk of water, and then 2 oil zones. But when we produced those lower zones, we got gas, and there was a view that the gas would be blown down and we'd get the oil coming through, which often happens. But the overall decision was to move away from those gas zones and recomplete. So that's a recompletion rather than a workover. And that recompletion was successful. We came up to a zone which hadn't been produced in other wells but looked like a good oil zone, and was tested, and sure enough it's producing very nicely from that zone. And so recompletions at Strawn will be more about picking the best commercial zone to produce in the short term.
Sorry, you say Strawn, you mean Stanley?
Sorry, Stanley, thank you.
My question was on Arkoma.
So Arkoma, the operator there makes those decisions. The production increase, we're very pleased to see the higher production levels, and but there's less technical work done by that operator, and we really just have to wait and see how those wells produce. It's one of those fields where production history tells the story, and if they continue to produce, we're producing from 2 of the shallow zones that our technical view is the better zones, the Union Valley and the Cromwell zones. If they continue to produce well, we think then there are other development wells that can be drilled to add on to that Arkoma existing well count. But we're monitoring the production history to form a view on that before we commit additional capital to that project.
So my ears pricked up when you said bring someone else in to fund, but my shorthand is so lousy I can't work out what I've written down. Which project was that?
Yeah, so with Welch, those wells are about $1.5 to $2 million for the horizontal well. You drill the vertical section, and there's an additional cost obviously for the horizontal, so they're more expensive. and we are in periodic discussions that come and go with people who either want to fund the wells or buy the project. But we're biding our time on that. But that's probably the way that we would fund that development project. Stanley, we're able to fund from cash flow at a lower working interest, and Champion and Challenger, with the higher working interest, we raised capital to fund, and we also recently farmed out a portion to an ASX-listed company called X-State, and that was to make sure that we get on with getting those wells drilled. So it reduced our position somewhat, but we're happy to get more wells drilled, albeit at a lower working interest.
And what are X-State's credentials?
So X-State are a well-qualified group of guys. On the board there is Ian Charkos, who took one company to a $4 billion market cap at Nexus. Another guy that I actually worked with on and off over 30 years ago. So a very strong technical and commercial board. They have drilled a well in California last year that didn't work out for them, and they recognise that Texas is an easier place to operate. And again, it's relationships. They're based in Melbourne. They also know the two guys that are with Baja that are based in Texas. A good group of people that recognise professional capability and good relationships. We think 3 partners is the right level to get on with business and get those wells drilled.
Any more questions for Andy? Andy, thank you very much indeed. Appreciate it. Thank you very much.
Thank you.